Assalamualaikum. Today our group will present about TechNova Berhad.
TechNova Berhad is a Malaysian-listed technology company facing pressure to meet analyst expectations for the financial year ended 31st December 2025. The finance director is concerned about declining profits and has proposed several accounting treatments. For the first issue, which relates to the impairment of assets under MFRS 136, the issue is that TechNova's software platform shows declining demand, which indicates possible impairment. However, management used aggressive growth assumptions and concluded that no impairment is needed. Under MFRS 136, the company must compare the carrying amount with the recoverable amount to determine if impairment exists. The appropriate treatment is to use realistic assumptions and recognize an impairment loss if necessary. If misapplied, assets and profit will be overstated, which may mislead investors.
MFRS 13, Fair Value Measurement, Issue 2. Assalamualaikum and good day. The issue in TechNova Berhad is the use of Level 3 fair value inputs for investment properties. These inputs rely on management estimates, but the assumptions used are overly optimistic and biased. Under MFRS 13, fair value must be market-based, neutral, and reflect real conditions, not management intentions. As a result, the company may overstate its assets and profits, making the financial statement misleading. In conclusion, this shows poor application of MFRS 13 and possible earnings management.
Moving on to issue 3, our group analysed TechNova's issuance of convertible bonds. Management has classified this entirely as equity. The treatment we find problematic under MFRS 132. These are compound instruments. The standards require split accounting, where the deposit must be divided between a liability component, the present value of future cash flow, and an equity component representing the conversion option. By classifying the entire amount as equity, TechNova is understating its liabilities and inflating its profit by masking the effective interest expense. This clearly suggests a bias towards earnings management to meet market expectation. From an ethical standpoint, this violates the principle of substance over form. As accountants, we must recommend a full restatement to ensure faithful representation. Now, the next presenter will discuss on issue 4 regarding segment reporting.
MFRS 8 Operating Segment Technical Perspective Misclarification Report is multiple business in single segment and falsely claiming similar risk and return. For the standard is MFRS requires separate report to monitor by CBM. The impact is of secure corporate risk of failing of high risk technology in hidden structure losses. For the treatment in segment reporting must follow internal management structure. For ethical governance perspective, ethical consistency is inconsistent. Earning management is the bias because commercial declining divisional profits. Responsibility enforce quantitative rules objectively. For the MFRS 124 related party transaction, technical perspective is misclarification provided minimal disclosure with limited detail. For the standard is MFRS 124 mandates clear full disclosure of transaction. Treatment is applied substance over form. Ethical and governance perspective. Ethical consistency is inconsistent, hiding related parties details. Earning management bias, yes, lack of the naturality to conceal company expenses. Accountants. Responsibility, maintain high professional skepticism.
In issue 6, the problem relates to the cash flow statement under MFRS 107, where interest paid was misclassified. For issue 6, TechNova misclassified interest paid as financing instead of operating. Under MFRS 107, interest paid is usually classified as operating and must be applied consistently. This change inflates operating cash flow and misleads user about liquidity. Ethically, it reflects earning management as it compromises faithful representations and transparency. Accountants must ensure integrity by following the standards consistently. The last issue is issue 7 that concerns the conceptual framework, where TechNova failed to uphold faithful representations. For issue 7, TechNova focuses on keeping profit stable and ratio attractive instead of showing the true financial picture. The conceptual framework requires faithful representation, neutrality, and substance over form. Ignoring these principles reduces credibility and can mislead investors. Ethically, this shows bias and earning management, so accountants must resist pressure, report the economic reality, and ensure transparency so that financial statements remain trustworthy. In summary, based on all the issues faced by TechNova, the company should follow ethical financial reporting by applying the standard consistently, ensuring faithful representations and maintaining transparency. That's all from us. Thank you.